All right, today's gonna be somewhat exciting episode for me personally. I'm gonna look at some current. I'm gonna talk some inflation. Gonna look at some currencies. But first, before all that, I'm gonna take you through the account, show you all my positions, the options, equities, everything, my performance so far, and we'll get right into it. Okay, inflation is probably one of my favorite topics, but I'm gonna approach it a little bit different direction. I'm gonna share my thoughts as to why I'm not looking for like a 2008 Michael Burry slash, deflationary crash in the U.S. stock market. All right, so this is the account. I'm sitting at 176,000 nearly. It was a little bit over, except after market there was a bit of a drop. I'm going to run through the options positions really quickly, so you can feel free to pause your video player at any moment to figure out the exact position. Daily change of the options on the right in percentage and in dollar terms. So feel free to pause anytime. A lot of options, not a lot of equities. So equities, Apple had a big positive day, which is why my account is in the positive. Otherwise, it would have been a bit of a wash. So Main Street Capital and Realty Income are pretty flat. I guess Main Street is down 1%. Goldman Sachs was up 1%. There was an article defending Goldman Sachs out that says that they're a good recessionary bank for some reason. I don't know why. I mean, they thrive on market health. So as long as the market's healthy, they should be fine. But I don't know about thriving in a recession. Like, I don't know what that's about. Paramount continues to drop, another 2% down, although it had a little bit of a resurrection here from the bottom, about 24.60. It managed to finish actually almost flat, including some of the after-hour action, and then there was a line, a dive back down to the $25 level. So I mean that's fine. That's fine. I sold 3 puts on this position at the 24.5 level. So if it drops to 24.50, I will be buying another 300 shares by Friday, which is also okay. I'm okay with that. I'm all right. It's cool. More Paramount. Fat dividends. In fact, let me see how if I received the dividend yet. I don't think so. Upcoming dividend activity 288, and that's on the 1,200 shares. So that's times 4. That's $1,000 dividend per year. I mean, it's not too shabby. And that's what percent of my account. 11%. So let's call it 10%. So 1,000 times 10, that's $10,000. If I had my entire account, right, it is leveraged, but still, if my entire account was invested in Paramount, I'd be receiving 10 grand of dividends per year. So that's some people's salary, especially outside of the United States. Inside, maybe part-time job salary. So it's pretty huge. Okay, moving on here. Enough number comparison. Those are the positions. We're going to go into the investing tab next. Check out the exact leverage of the account. 36.36. I'm 63. I'm not dyslexic, or am I? And of course, we got to double that number to figure out the exact leverage of the account. So we're sitting at 72, 73 percent leverage. This is the account sorted by total return. Apple is number 1. Then Realty Income, Main Street currently, and then sorted by equity. Apple is the largest position, then Goldman Sachs, then Main Street Capital. Paramount, number 4. All right, so that's the portfolio. Now we do the performance. So performance today was up, 0.5%, 6.39 on the week. Oops, excuse me. Negative 1.3 on the month. Negative 10.55 on the 3 month. Not good. Negative 0.85 on the year. The old chart, I have to always disclose that I started investing over here at August 28th, 2018. So that's why the line is flat on the left. This is the all-time performance. This is the March 22 crash here. All right. So let's check out the SPY. I was negative 3. What was my biggest drop? Negative 10.5 on the 3 month. SPY. Show thyself. Okay, about flat on the day, maybe a tiny bit negative. Only 1% up on the week. Negative 7.56 on the month. Negative 17.44 in the 3 months. And negative 11 on the year. So I was about flat on the year, maybe negative 1%. Alright, and this is the 5-year performance, up 55%. So still doing better than the market. I'm glad about that. Recent performance has been boosted by the Chinese positions. But to be fair, I lost a lot late last year due to the Chinese stocks. If I had held only American equities, I would have been probably over 200,000 right now. But Chinese, well, I don't know, maybe 190. So the Chinese stocks really killed me at the end of last year and the beginning of this year. So it was a deadly grind lower, and I was trying to accumulate. And as soon as they popped, I decided that it's not worth the trouble. So I only bought leaps just in case they do skyrocket. So I have 4 JD leaps here. I don't know if you want to call a 6-month play leap anymore, 7-month play. But I have some YOLO VIP shop calls. Only a couple of them. Lost some money on those already. Then the big play is the Alibaba 140 calls for 2024. So a couple years out, a year and a half out. And then a YOLO 235 leap on 2024. So those are kind of the big plays on the option side of things. I keep hoping that PayPal is actually going to have, a nice run, but because it was so beaten down, but it seems to be like very slow on its rise. And who knows, I'm thinking things will start improving by the beginning of this winter. And so PayPal will catch that wave, and probably, I'm hoping that it goes to 150, 160 or something like that, or higher. So we'll see if that play works out, or I'm just going to lose all that money. Okay, so those are the plays. Now I want to talk a little bit about inflation, okay? Like this, and why I'm not looking for a deflationary crash like 2008 style. Although that is, of course, a risk and a possibility, a lot of it is mental, right? If something goes wrong in the credit markets, or, there's some kind of unforeseen event, of course we could have the crash. But as it stands right now, in my opinion, inflation doesn't work that way. And I've lived through a hyperinflation myself. Like, I've lived through years of very, very high inflation. And so I know that the stock markets generally actually keep up with inflation. That's actually true in American history as well, or at least they stay flat. It's true also in German history. Their stock markets also kept up with inflation during like even hyperinflationary scenarios. Maybe they lost a little bit, 20%, whatever, but it wasn't like 90% of the value of the markets was erased, because they generate cash flow. People need services, they need products, so they'll throw all that extra money that's been newly printed, whoever receives it, into products. One product that I know everybody can't live without, especially in the Western world, like the UK and America and a few others, I imagine Australia. I don't know the figures for Australia, but I know the UK is really heavily invested, is Apple. So my personal opinion is that Apple is like more important than food for some people, for a large portion of people. That's my opinion. So they would rather have put the newest iPhone on the credit card, and then pay for it with high interests, even if they can't afford it, for a long time, and skimp out on food rather than eat well and have no new iPhone. Like, that's my personal opinion. I mean, I share that sentiment a little bit because I have, this car sickness. Like, I really like cars, and barring recent history, I guess, well, even not even barring recent history, I will buy a car that's over my budget, and I will suffer for it in the long run just so I can drive and have a good, nice driving experience. I feel like most people have the same thing going on. Not most people. a large portion of people, I don't know if it's most or not, have the same sickness going on with their phones. I mean, I share that with my phone to an extent. I'm waiting for the newest update. I have the iPhone 11 Pro, which is really old in today's standards, but I'm waiting for the new visual update where they get rid of this notch here on the home screen. On the screen. And I think this year with the iPhone 14 they're doing it. So I can't wait. I'm going to upgrade the phone and I'm going to love it. Okay. So I'm one of those people. I mean, and I think I'm not alone, but I could be. So anyways, back to inflation. Markets just don't crash like that during inflationary periods. I mean, they're, the source of revenue. Like, that's where all the cash comes through. And so nominally, they're going to do well. In real terms, they might decrease like by 20%, like I said, or something. But I don't think there's going to be like a deflationary crash where just, demand completely collapses. I mean, if, prices manage to get to this point and this high, that means that there is enough demand, right? People are switching jobs, they're getting higher pay, minimum wages have been raised, etc., and there's opening at minimum wage level. Even though people are not collecting unemployment checks, they're not collecting stimulus checks, they have the opportunity to earn a larger amount of money than they did in 2019, especially at the lower ranks, right? Well, at any rank, really. I'm not necessarily making more money, I'm not. But I'm a special case. I think most people are going to be making more money now than they did in 2019. The job market is more accommodative. No matter how you look at it, objectively, the market, not in specific cases like mine, like if you're making less money now, I feel you, okay? But, many people actually are making the same or better. I heard that there's even shortage on things like lifeguards, like national shortage. So if you're a lifeguard, get certified and demand some more cash because people are looking for lifeguards. So as I was saying, I get sidetracked a lot. But that's it, I get sidetracked. As I was saying, inflation, not looking for a deflation crash. Could it grind lower the market? Yes. But I don't think there's going to be huge, like 30% down from here. So it's a very peculiar situation going on right now. I'm going to look at some currencies. Let's start with the UUP, which is the dollar index, basically. It's an ETF that follows the dollar index. So first we got to know what we're looking at. So this is, before we look at this 1 year graph, which has been rising, I decided to check out the prospectus of the UUP, and basically is what the dollar index is as well. If you can't see these numbers because they're too small, it says that the index is comprised of 57.6% euro. So this is more or less the index, a play on the euro. They try to include some of the major currencies around the world here, right? We've got Japanese yen at 13.6, British pound at 11.9%, Canadian dollar 9%. I guess it kind of tracks with the Australian dollar, so there's no need to include it there. And same thing with the New Zealand dollar. And Swedish krona 4.2, Swiss franc 3.6%. So basically, like 60% almost is euro. So those are the currency included, and this is how the dollar has been performing versus these currencies in the last year. I mean, it's killing them. It's up 13.15%. That's really good. This is the 5-year chart. Alright, 5-year chart. 11.66, but in the last year, it's been absolutely murdering them. So, let me get this straight, right? So we have inflation in the US. That means the dollar is falling in value versus real things, right? Like services, products, commodities, gas, food, alright, versus all those labor, versus all those things, the dollar has been falling. So, but it has been rising relative to most major currencies. If you're wondering why the Japanese yen isn't in there, I think it's because they peg it a lot. pegged to the Hong Kong dollar or something, which in turn pegs to the US dollar. I don't know. But it doesn't really move that much. So I didn't really look at it. But I looked at some other ones to try to figure out, okay, so if the US dollar is so strong relative to other currency, that means other currencies are experiencing even more massive inflation. And in fact, I listened to an article today about some possible hot zones where riots and unrest could unfold due to the high gas and food prices, which are very, very important for most people. I mean, that's basically everything that a regular person consumes, right? Energy and food. What else are you consuming? You can cut out the rest, like, unless you have an iPhone. Okay? So I decided to look at some more stuff. So how about we look at the Pakistani rupee, and I pulled out the 5-year chart. I know it's kind of small, but you can see the downward trend. I'll tell you what the numbers are. It went from 0.0094 and it's 0.0048 now, so it halved over the past 5 years. Over the last year, it's gone significantly down from 0.62 to 0.0062 to 0.0048. So those are big drops in currencies. They're not insignificant. I wanted to look at the Nigerian naira. I don't know how to pronounce that correctly. So if you know how to pronounce it better, let me know. So in 5-year terms, I think it's attempting a peg, but the peg has been faltering in 2021. So even that devalued against the dollar. How about the Brazilian real? Brazilian real on 5-year charts down, from like 0.32 to 0.19. On the 1-year chart, it's up, but it's only up because of the recent commodity boom, right? So some of these commodity currencies are actually improving. Like, probably the Aussie dollar would be up. I'm guessing the Canadian dollar and the New Zealand dollar, because they usually trade in lockstep. But we'll see it. We'll see that. I'll check it out too. We have the Indian rupee. India is a very big, populous country, so its currency is important. It's been also dropping, and lately in the 1 year, you can see it went from high 0.13 to low 0.13, I guess. Well, I guess it's frozen or something. I don't know. Well, it was 0.16 here, now it's 0.13. It's been dropping quite a bit. It's probably like 8 or... If it's high 13 here, low 13 here, that means 14 or 13, 10%, I don't know. Significant. Kazakhstani tangi. I don't know how to pronounce that either. But I just picked some random countries, really. It looks like some peg faltering here as well. So a steady grind lower. And of course the ruble. Look at the ruble. The ruble is the only thing that's green here. It's kind of crazy how the one country that's been isolated from everyone has been doing the best currency wise, and the reason why this Russian ruble is higher is of course because the European countries have been en masse for the most part have been forced or extorted, I guess, and have been required by Russia to pay for their oil with rubles, and therefore the currency necessarily has to be bought out and strengthened. So Russia is actually benefiting from all this. Like, they're not losing the currency war, they're not losing the demand war. They have resources of the key resources that people need to survive, like energy and food. They have plenty of those, and they're exporter of those. So they're actually in a very good position for tough times. So even though economic sanctions will be unpalatable, they'll be uncomfortable, or it's not uncomfortable, unwelcome. Russian citizens would like not to be sanctioned. Obviously, everybody wants imported products. They don't want to live behind the Iron Curtain like I did for a period of my life. I bet the vast majority of people don't want to do that. Oh, actually, I don't know that. I don't know. But I certainly wouldn't. And I know others wouldn't. So, But anyway, the prices for everyday goods there are actually pretty cheap. Like they're not overly expensive. The currency is doing well because they're such a big energy exporter. So, you know, that's the Russian ruble. Let's take a look at um, New Zealand dollar. Or actually, how about Australian dollar? Dollar versus USD. Let's pull out of the 1 year chart. It's actually even falling. I'm surprised. What about Canadian? Even though Canadian has been included in that UUP index. Oh, fairly flat. Actually been falling too. So they're only the Russian ruble really has been gaining on the American dollar in relative terms. So Russia, ironically, since they were the match that lit the late 90s hyperinflation period, they're ironically the strongest currency right now. So that's the reality. But US dollar is number 2. So as far as I can tell, at least from the currencies that I've looked at out of the major countries, if you know a major country that has a strong currency, okay, fine. Let's look at the Japanese yen. All right, we're gonna look at the Japanese yen. I mean, not the Japanese yen, the Chinese yuan. I know they were trying to maintain some kind of peg. I don't know why it's grayed out, but this is the 1 year chart. Even it was going up, but even the Chinese yuan dropped like 10% here. Significant drop in the last few months. So I think that coincided with the little pop up in Chinese equities. So I guess the strong yuan was kind of strangling these companies apparently. We'll see what happens. But even the Chinese yuan is falling. Let's see, Chinese RMB, was it? Renminbi. The yuan, okay. Or was that the name of the treasuries? I get confused. Anyway, even the Chinese currency is falling against the US dollar. So US dollar is basically number 2 in the entire world after the Russian ruble in strength at the moment, which is crazy. And we're experiencing such high inflation. Imagine what the rest of the world is experiencing right now. But I started speaking about hyperinflation and safe havens, and if you don't have things like gold and things like that, the stock market is actually the best thing. You know, they have the cash flow, and traditionally, historically, they've kept up. They haven't collapsed. And just think about it from this perspective, right? Like, let's say bond yields go high. The companies, the stock market in general, the companies that end up swimming out of this mess will always be better for over the long run. In short periods of time, even for a few years, they might not. They might get beaten out by bonds, but over the long run, they will prevail, because otherwise, check out this logic, right? Nobody would invest in the stock market. Public business would actually be completely dead. There would be no reason to invest in stocks if you could get better return in government debt. Right? The whole point of the stock market is basically an option play on government debt. So if you can't make more than that, literally everyone will pull out. So you always being in the market is always going to be the best thing. I can't imagine a scenario where the stock market just goes away, and if it does, like, our little portfolios are the least of our worries. Okay, it's the least of our worries. We have entered the apocalypse. So, anyways, not looking for a huge deflationary crash. There could be another 10-15% down. I'm guessing it's going to be a slow grind. Could be volatile, maybe over the next 6 months. But I expect things to start recovering during the winter. I expect a lot of the supply chain issues to get cleared. I expect efficiencies to start picking up. All these technologies we built up during the last couple of years start actually kicking in gear. and I think that economy will come back strong. It's just my personal opinion there. So anyways, I bet mostly Apple for both of these scenarios. I think they're going to come out on top no matter which way the economy swings. So that's why I'm positioned the way I am. Okay, a really long episode today, but I thought it was good. I think I got a lot of things off on my mind. I got them out. So that's what I've been thinking about. Let me know what's your number one thing on your watch list. So perhaps I can look into it and learn a little bit. All right. Peace out for now. Bye.